Hey, folks. Happy Friday, August 14th. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller. Great to be with you here today on a beautiful day here in Redmond, Washington. Not a smoky, which I'm digging it. I'm here in downtown Redmond today, and it was good to walk around and not, you know, uh, experience some of the wildfire smoke that has been plaguing this area. Hopefully, it continues to dissipate. Hope you guys are all doing well and breathing clearly wherever you're at. Technology snafu of the day today. So the reason why I'm about a minute and a half late kicking off the show. So I'm getting all ready. I'm plugging in everything. The audio's not working. The audio's not working. I'm ready to just like completely start over. And then I looked and the cord was about a quarter inch outside of the plug. So that's a good one. I feel like I'm a train wreck this week with technology, but hey, we're resilient. We're getting to it, and I'm glad to have the show running. We're live streaming, by the way, on Facebook, YouTube, and X, and I appreciate you, those of you tuning in live here on Friday afternoon at 5 p.m. Eastern. I've got 5 questions from all of you guys here in the last week or so, and I appreciate you sharing questions during the live stream. Keep them coming. You're welcome to throw them in here. We're actually going to be doing 2 mailbag episodes for the next 2 weeks, as I mentioned, and just to reiterate, going on vacation next week. And so we're taking the next 2 weeks off from the live shows. But here's what we're going to do. Next week, we're going to do a 4-part series, which we're calling the 4 Deadly Sins of Traders. A number of you mentioned you watched a webcast we did with Interactive Brokers this week. For those of you that missed it, you're going to get a 4-parter through the course this week. Every day we'll release a new episode, and I hope through the course of the week it makes you think about some of the common behavioral mistakes you might be making in your process. And then Friday, I have an all mailbag episode that'll be queued up for you. The week after, we've got another 4-part series and a mailbag episode. So a lot of fun. If the S&P does close over 8K while I'm gone, I will not have the trumpet with me in Iceland, but I will be ready and prepared emotionally and hopefully physically to play when we get back. All right, that's enough of an intro. Can we look at some charts together, shall we? Here we go. So look, the S&P 500, kind of a quiet day, ended up being slightly lower. Same for the NASDAQ, same for the Dow. The VIX is down almost below 14 going into the weekend. We're at 14 and a quarter on the VIX. And that level of the VIX means days like today should be pretty common, right? Days with small percentage swings. This is what this feels like. And if it feels weird, that's because we've had so much volatility for so long and such significant moves all around. And so this feels a little strange. But there are periods when the market volatility is going to lessen. We're in one of those. There's going to be a period where smaller percentage swings should be more the norm. That's where we're at. That's the good news. The bad news is the VIX spikes, and that's going to be your warning sign. So I would say when the VIX is this low, we're just looking for a surge higher in volatility, which is often a sign that people are starting getting nervous. I think what's going to happen next with the VIX is why it's known as the fear gauge. It's not for this, which is like low fear. That spike in volatility usually means a spike in investor anxiety, and that usually means the market is rotating lower. But with that in mind, look, mid caps and small caps pretty good. The S&P 600 finished basically at a new high, up about 0.5% for the day. So that small and mid caps both outperformed their large cap counterparts. Just quickly checking in on other market data here on Friday, and then we'll get to some of these questions. Rates generally moving higher, which is good to. I don't want to say that's good to see. I guess good to see because that's kind of what I'm thinking was going to happen. So I guess that's what I meant by that comment. But 10-year yield up around 4.7%. Long bond yield now back above 5.25%. So what's happening is the yield curve continues to steepen here, and that steepening yield curve is good for certain sectors, often not as good for others. But one of the most common kind of cause-effect relationships you can keep in mind would be financials, particularly regional banks. That's where a sort of normal-shaped yield curve is pretty good because that's literally how their business is laid out, right? Borrowing money on the short end and lending money out at the long end of the curve. And so, steepening yield curve, rates going up at the long end here to finish the week. Usually good for regional banks, and they've generally been doing pretty well here. The TLT, which is a bond ETF, Treasury bond ETF, was down about 0.2%. The dollar index coming off as well. And what's interesting about the weaker dollar is that tends to be good for commodities, and that's certainly what we're observing today. Very interesting to see a bit of a disconnect between gold and silver having pretty good days through the course of the day today. The GLD up 0.6 per, excuse me, gold future that is up 0.6%. Bounced off $4,000 an ounce and now rotating higher. Crude oil prices, of course, going up. Crude oil prices have been coming down through the course of the week as the headlines out of the Middle East were, a little more encouraging, I guess, implying, lessening of hostilities now. Market kind of bouncing higher in that regard. And the energy sector actually had a pretty good day as well. Also noting soft commodities all showing some upside pressure as well. Cryptocurrencies sort of weaker along with a lot of equities today. Bitcoin down 0.9%. Just slightly below 63,000. You can see most of the top coins were down today. Just checking in elsewhere on the market data here to finish the week. Energy, utilities, and materials at the top of the list. So, not a growthy day. This is more of a value over growth kind of day. The energy sector, of course, at the top of the leaderboard, up 1.4%. That's because crude oil prices were pretty good. And utes and materials also up. On the downside, only 4 of the S&P sectors were down. The problem is one of the biggest, the biggest by far, technology, which is about 40% of the benchmark, down 0.4%. Healthcare just down just over 0.5% as well. Breadth was kind of neutral, kind of slightly better than not, but not overwhelmingly positive. We're noting large cap growth was definitely the worst place to be in today's session. Also, large cap core, which was slightly down. The rest of the Morningstar style boxes were all in the green. And Micron, I would say, noticeably popping higher. We've highlighted some of those names like Micron, like Seagate, kind of pushing back above their 50-day moving average, and a little more of that here on today's session. Broadcom, on the other hand, having a big down day, down at 6% today. It's one of the worst performers out of the Mag 7. We're certainly the worst out of the Mag 7, but one of the worst that you'll see on the heat map today. Two other quick kind of, I don't have like a corrections column, like in the old school, back when there were newspapers. For those of you that are too young to remember those, I miss those. I loved reading the paper, and used to buy one at the newsstand every day on the way to work when we lived in New York City. So I don't have a corrections column, but if I did, here's one thing that I would note. I mentioned earlier the RSP as an equal-weighted S&P 500 ETF, and a number of you astute watchers of the show, members of Market Misbehavior Nation, said actually the S&P equal-weighted index is right here on Stock Charts. You're absolutely right. I literally cannot remember the last time I brought up this index. I just always bring up the RSP. You're absolutely right. Nice catch. You're absolutely right. Ticker $SPX is the regular cap-weighted S&P, but on Stock Charts, $SPX EW is the equal-weighted S&P. Now, I'll caution you, if you use platforms other than Stock Charts, index tickers are very different on different platforms. There's no, like with an equity, there's one ticker set by an exchange, and all the different platforms use that same ticker. With an index, there's no such like index regulator that sort of organizes those tickers. It's a bunch of firms like S&P or Russell or FTSE or whoever else is involved that actually develop these different indexes. So as a result, there's no central clearinghouse that determines the tickers too. So every platform is a little different. But if you look for S&P 500 equal weight, hopefully the platform you use will surface this particular index. So great catch. I missed that. You're absolutely right. And thanks for sharing that with your other viewers. I appreciate it. Final comment I would make, as I'm finishing the week here, I had some questions for my premium members, and we were using the Stock Chart Screener tool, which is a really cool part of the platform that was just recently added here in the last month. And I was scanning for stocks making new 3-month highs. And, I won't go through a lot of individual stocks on today's episode, but Expedia comes to mind, having just booked a bunch of travel for Iceland. And then I've got a trip coming up in the fall going to the Money Show in Orlando, going to the IFTA conference in London, going to the CMT Fall Summit in Bethesda, Maryland. So I was working through all of that. And so Expedia was top of mind. I didn't actually use Expedia, but I know of it. And, making a new 52-week high today. So there, friendly reminder, there are charts out there going higher. And I always finish the episode with, it's always a good time to own good charts. For me, regularly scanning for stocks making new 3-month highs, certainly part of that process. All right. Hey, thank you so much. Those of you that have shared questions, these questions have all come from our live stream during this week. Also, questions that have come in on our YouTube channel. As I mentioned, we're going to be traveling the next 2 weeks, taking my family to Iceland. It's been on our bucket list forever. This is our last kind of big trip before my daughter goes to college in a couple weeks. And so we wanted to go out and do something kind of crazy and remote and fun. So we're going to be doing the ring road around Iceland. Having said that, you are welcome to drop questions in our YouTube channel. I would appreciate it so much because when I get back, I'm going to want to do more mailbag episodes featuring some of your thoughtful questions. So keep them coming on our YouTube channel. And many thanks to those of you that submitted the questions we're featuring in today's episode. Here's question number one. Multiple times during the past year, you've mentioned working on the buy side versus the sell side. What does that mean and what is the difference? And I appreciate so much just the honest question. I'm a big supporter of the idea that there's no such thing as a bad question. I think this is a great one. So here's the thing, right? And it's funny. There's a lot of vernacular and a lot of language you use within the financial industry, and it becomes kind of secondhand. But I'm well aware, having tried to describe to people who are not in finance, here's what I do, here's where my background is, and here's the type of firms I work at. Those sort of phrases are less familiar. So sorry for using, if I ever use phrases like that, that you're like, what the heck does that mean? Please drop them in the questions and I'm happy to do it. So, I mean, this comes from kind of a very, I mean, I would say kind of simplistic way of thinking of the financial industry as two main buckets. And this comes from like back in the day when it really was kind of like the two buckets, but it's definitely grown, and the financial industry is a sprawling industry with a lot of different components now, and a lot of firms that are actually doing both of these things at once, to be honest. For example, the firm I used to work with, Fidelity, has both a buy side and a sell side arm to it, right? So you think of this, the buy side would be investors of money. They're the, sort of hypothetical investors buying the shares that the sell side, the investment banks, are selling. And I guess the way to think of it is like in the IPO process, the initial public offering process, and an investment bank helps the company go public. They actually, sponsor the deal and release the shares into the public, list them on the exchange. So they are the sellers of those initial securities, and then investors like you or me pool our money together with big firms like a mutual fund company or an ETF provider, who then basically on our behalf buys these shares that have gone public. That's where the names buy side and sell side come from. So having said that, which firms are considered buy side firms? Those are like asset managers, hedge funds, insurance companies, pension funds, right? It's like a teacher fund or like a state employee retirement system. And some of those, to be honest with you, some of those buy side firms are huge, right? So I used to work at Fidelity, worked in the asset management division. So we ran all the mutual funds. So that's a buy side firm, a pretty large one. But there are small buy side firms, small advisory firms, small ETF firms or small funds that do a similar thing, but just a much smaller scale. And then pension funds and insurance companies, kind of those that are investing assets pooled together from other investors. Those are all considered buy side. The sell side would be broker dealers, investment banks, kind of the firms who are tasked with maintaining liquidity and maintaining a normal functioning system, or are considered the sell side. Now, the reason why we often talk about that, and I usually talk about that distinction when I'm talking to younger investors. So if you are a younger investor trying to get into the financial industry, or you have a son or daughter or grandson or granddaughter who is looking to get into the financial industry, I would argue that thought about which side of the market you're on has incredible ramifications for your lifestyle, for the nature of how you interact with others in the industry, for the type of work you're probably going to be doing. And so I often encourage people to think about, are you, start at the very least, start thinking about, are you more like a buy side kind of person or a sell side kind of person? And this is oversimplifying, but the way I usually describe it is, and this is probably oversimplification. I apologize if this doesn't fit with your own experience if you've been in the industry, but the sell side definitely driven more by competition. My experience with sell side firms like brokerage dealers, with research firms, with things like that, it's super competitive. You're competing against a bunch of other brokers that are all very much incentivized to get business. As a result, it's a little more cutthroat, if not a lot more cutthroat. It's more on competition. It's more on outperforming your competitors and demonstrating how what you're doing is value add beyond, what others are doing. So the people that I've generally seen that succeed are ones that, a lot of former athletes, people that are like super competitive and love that game of trying to come up on top and beat the competition. The buy side, generally speaking, a little more collaborative, a little more team oriented, right? And I knew from my time at Bloomberg, where I spent a bunch of time at sell side firms like trading desks and brokers, and then a bunch of time at asset managers and things like that, more thoughtful way of thinking about, an investment thesis and getting a bunch of info and then trying to develop a portfolio as a result. You did better not because your teammates did worse. You did better if everyone did better. So instead of pushing down on other people to get higher, you're kind of lifting everyone up and kind of rising up at the same time. For me, that is way more my personality. And the more trading desks I've spent on, the more I'm like, that is not my gig. I'm doing this other one. Now, having said that, are there people of both types that work at both firms? For sure. Are there people that have very unique and unusual experiences? Absolutely. But that's kind of what that means. That was my 5-minute rundown on the buy side versus the sell side based on my own experiences and talking with, hundreds, if not thousands of people that have done that thing. But I would say the reason why that's an important distinction, because the business models are very different. Certainly the corporate culture can be very different, but I've encouraged people, particularly younger investors, to trying to get in the financial industry. That's one of like the initial kind of thoughts to think about, because if your personality is one type and you're in a role that doesn't fit your personality, I think that's a really sad career, regardless of how much money you make, to be honest with you. All right, question number 2. Hi, David. Could you compare the utility of weekly versus daily technical analysis? That's such a great question, especially when they are discordant on key indicators like RSI and MACD. Great use of the word discordant, number 1, in your question. So I commend you for that one. So there's actually two, I guess the one main question is about multiple timeframes, right? How do you think about weekly versus daily timeframes? So a lot of my process, and I would say for a lot of technical analysts, like I was just talking with Katie Stockton, interviewed her yesterday. That episode we're probably going to get out to you late next week, because we've got 4 episodes. We've just got one out today. We've got I had a number of interviews to try to, make sure we had some content for the next week or two. So there's going to be some really good episodes of the podcast coming out. With Katie Stockton, we talked particularly about multiple timeframes. And I would say, as a technical analyst, that's one of our great advantages, is being able to look across different timeframes. If you're looking at a company fundamentally, there's only so much you can do. There's very little you can do really with multiple timeframes. You don't think about the short term versus the long term. It's more like, here's the investment thesis. Is the price at a good valuation for what I think this company is going to be able to do? And that's the question. For a technical analyst, I can be looking long term at secular trends. I can be looking medium term at cyclical trends. I can be looking short term at tactical trends. And those are the 3 timeframes I think about. And a lot of my charting approach is built around those 3 different timeframes. For example, when I bring up a stock, I click on the daily chart looking about a year and a half of data. I click on a weekly chart looking at about 5 to 7 years of data. Then I look at a monthly chart going back around 20 years of data. And I ideally would look at all 3 of those timeframes to think about the big picture, and recognizing that Expedia is so much above its 2009 low, or its 2008 low in this case, seeing how it was really sideways in the late teens coming out of the COVID low in 2020, the pullback into the 22 low, and then just the remarkably strong trend we've seen in the last year. But those trends in the last 3 years really make sense when you look at it relative to all of that previous history. Then on the weekly time frame, we can really understand this last 3 years and how it's really built some upside momentum. The daily time frame allows me to think more tactically and recognize we're just getting above that January peak. The moving averages are in the proper order. We're a little overbought right now. Now I can think a little bit more on that tactical time frame. So I would say the charts are all valuable, and I would lean more into one versus the other if my time frames are based on my investment goals and my investment horizon. Working at a large buy side institution, now that we got that word under our belt, we would often have analysts sharing a lot of weekly and monthly charts with us, because the daily charts were just too noisy and it would just take us too long to accumulate a meaningful position. So our edge for some of those funds was just thinking more about structural long-term shifts. And the weekly chart was a great starting point. Now that I'm working with more individual investors, I've started using more daily charts because we're thinking a little bit more about the tactical time frame and how that relates to some of those longer term trends as well, and all those time frames in between. With indicators like RSI and MACD, I would say the very good thing about them is that they are designed to be time frame agnostic, meaning if I'm looking at a monthly chart or a daily chart or like a 5-minute chart, with some tweaking potentially needed depending on the indicator, but overall the methodology should be pretty sound. And my final comment, based on your question, would be that certain indicators I have found tend to speak more on different timeframes. So, for example, I very rarely use the daily PPO or the daily MACD, but I have found the weekly PPO and the weekly MACD to be incredibly powerful. For example, on the chart of Expedia going back for the last 3 years, we've had 3 buy signals from the PPO indicator. The most recent one was in June of this year, about 2 months ago. Before that, we had June of 2025. Here we had June of 2024. Now, did those identify the bottom at the bottom? No, because they're lagging indicators and they signal soon after. But if you look, it basically identified kind of the 3 times looking at the chart. I probably really want to start accumulating shares of Expedia, like the weekly PPO kind of highlighted those very, very well. So I found I lean more into like the MACD and PPO on the weekly chart. I don't often use that on the daily chart. Just the price and the RSI and the relative performance are kind of what I've come to find most helpful on the daily time frame. So those are some observations. I would say the utility is pretty high across the board, across those time frames. That's kind of the benefit of technical analysis. You can apply it to different time frames. I would just say each of my daily, weekly, monthly charts do look a little different because I found different indicators work well on some time frames versus others. Next question. I recall you before you mentioned being long gold, but you remarked in your recent webcast. This is the one on the I think on the morning coffee routine, which was a couple weeks ago. On your recent webcast, that gold hadn't been good. Can you explain your process of analysis and entry and exit for gold? And more recently, since you shared this question, this is one, by the way, that's been in the mailbag for a little while. I've just been waiting for the right time, and I thought it would be helpful to bring it up because gold's now kind of reversed back to the upside. Your question was, talk through some of these different turning points, essentially. And I would say, yeah. So when you're analyzing a chart like gold, for me, it's based on the weight of the evidence, right? And so I describe my approach as evidence based, and the reason why we do an evidence based approach is because we do not want to do an emotion based approach. If you don't have a disciplined, consistent, kind of checklist oriented process for evaluating a chart, then you're probably making decisions not as much on the evidence and more on the emotion. And you're using the chart to feel better about the decision you've already made. It's called confirmation bias, and you don't want to do it. So the way that we get away from that is have a consistent process of analyzing the evidence. For me, that means having a mental checklist of 7 things that I review every time I'm analyzing a chart. And I literally start at the top and I go down. The top of the chart, the top of the list for my checklist is the trend, right? Define the trend. Are we in an uptrend, a downtrend, or a sideways trend? An uptrend is a pattern of higher highs and higher lows. So I would say gold in the second half of 2025 and really through the end of January, pretty clearly in an accumulation phase or an uptrend, higher highs and higher lows. So for me, great time to own gold at a pretty decent position in GLD and an IAU at that time, if I remember right. Probably some gold miners in there like GDX, I would guess. But I don't necessarily remember that one. But I remember the gold, like the physical gold ETFs, definitely owning them because they absolutely crushed the equity indexes in 2025. Then something happened here in January and particularly in February. And I would say for me, the big warning sign on this chart was this point here where we made a lower high, right? So instead of making higher highs, all of a sudden we're making a lower peak. And we had a very similar pattern, by the way, back here in November of 2025, which I remember seeing this and being like, uh-oh. And after that uh-oh moment, what did not happen? Well, we didn't break down through any key moving averages. We held the 21-day, we held the 50-day. The RSI never really got much below 50, so it still wasn't bad. And we definitely did not break the most recent swing lows. And I was watching this 360 level on the GLD very closely. We never broke it, so it encouraged me to sort of think still on the long side. The opposite happened here after that lower high at the beginning of March. because then all of a sudden we're breaking below all those moving averages. All of a sudden the RSI is breaking below 40. So by this point, I'm pretty much unwinding that trade in gold and starting to lighten up. I would encourage you not to think in absolutes. So don't think of like I own 100% of gold and then I own 0% of gold. I think more like how, a lot of institutional investors would think, which means you are adding to your position or reducing your position, right? You're doing it in stages and not in like one big hatchet type of move. And so for me, lightening up on the initial breakdown, lightening up part of that position, continuing to reduce the position as it becomes clear that we have weaker momentum and weaker trend. Those are the times those are the reasons why I was lightening up in March. And then basically very underweight my normal position in gold until about a couple weeks ago. And what we've been highlighting on the show has been this trend line tracking the downtrend in the GLD and in gold as well. Bullish divergence we picked up in June, but still going lower. We started to find support here, and actually, as we held that $4,000 an ounce level on spot gold, I started to add a little bit, and then added a lot more as we broke above this trend line, and definitely when we broke above the 50-day moving average. So that by this point, I'm kind of getting back into it. So I'm sort of back to a growing position in gold, and for me, a break above the 200-day would be that final like, now's the time to kind of be, fully invested, if not, adding a larger position. So for me, those are some of the kind of guideposts along the way that encouraged me to be fighting, playing on the long side, encouraged me to be lightening up, encouraged me to be underweight, and then helping me rotate back and forth. And I mean, gold has been an incredibly straightforward trade, I would say, over the last 18 to 24 months. If it was always this easy, life would be pretty good as a technical analyst. I would say it's not always that straightforward, but gold is pretty good. And I would say, still doing quite well here. And I do at this point, yeah, GLD and IAU, I believe, are the only two active gold bets I have in my own portfolio in terms of disclosures here. All right, we'll continue on in a minute. I do want to give a quick shout out to one of our partners, Seeking Alpha. They've been longtime supporters of market misbehavior. They recently created a new growth and income product called Quant Growth and Income. Three things that this Quant Growth and Income product is looking for. Number one, long-term capital appreciation. We want positive price momentum. Number two, consistent dividend income. So these aren't necessarily high dividend payers, but consistent dividend payers. And then number three, they try to reduce exposure to dividend cuts by focusing on Seeking Alpha's dividend safety grades. So they want to minimize the chance that these companies are going to be reducing or cutting their dividend. No guarantees as always, but they're using their quantitative platform to try to identify those names. It's a working list of stocks you have access to, and they update a couple every month. They rebalance it as well, so you can always see the latest names in the model. Again, you can go to marketmisbehavior.com/growth income. They're offering my viewers 10% off if you check it out and take a shot at the new Quant Growth and Income platform. Thanks again to my friends at Seeking Alpha for supporting Market Misbehavior. All right, let's get to the next question. Dave, if I own one of those stocks whose share price gaps down due to earnings or some other reason, do I sell now or do I wait for the follow-through day? Oof. So one thing I will never do is tell you what to do. So full disclosure, as always, I'm not here to recommend buying or selling anything. My goal is to equip you to make those decisions for yourself and to do those with good experience and with good tools and techniques based around technical analysis and behavioral finance. With that disclaimer out of the way, what do you do with names that have sort of gapped around? And there's been a lot of kind of gappy price action around earnings, right? So, I mean, you can look at any of the Magnificent Seven names at this point and probably have some good gaps to work with. So let's pick one that's a good one. You'd mentioned like something gapping lower. Yeah, like Apple's a good one, right? So Apple gapped lower. They reported earnings on July 30th with that big gap down the next day. And it sort of chopped around a little bit there. So what's so interesting about the chart of like Apple, for example, so, the short answer to your question is it depends. I'm not a fan of just blanket, of making a blanket statement for something like this. I think this is more with earnings related gaps. For me, it's less of a hard and fast rule. And it's a more, here are all the things that I would consider before I would make that decision as to whether to hold it or not. So when you have a stock that's gapped higher, rules are a little different. And for me, it's more what happens immediately after that gap, right? So if we're gapping higher, is it a gap and run right after we gap higher to see additional movement? That's super bullish. If we gap higher and then fail, that is often a sign of a real, sort of a blow off top where the last gasp has been made, or the last gap, I guess, and then we're rotating lower. But when you have a gap down, the company misses earnings, I immediately look to the left on the chart, and I immediately start to make these sorts of assessments. Have we gapped below any key levels of support? Have we gapped below any key moving averages? After that assessment, what's happening soon after? Are we finding buyers coming in at this, reduced level? Because a lot of times, what happens when a company misses earnings, they miss, the company, the price gap down for a reason, right? So something was not welcomed by investors, and so the stock already has gapped down. But what happens after that can be very telling, because you basically got, in the case of Apple, you got a 10% off coupon on a great company. So at a 10% discount, even given the negative news that caused the price to go down, but did the price go down enough that even despite that negative earnings release, whatever it was about, is there enough still there? I mean, Apple's still a good company, I would argue, and still making tons of revenues. They're still earning a lot of money, but it's more like the price went down 10% because of changes in expectations. So is it low enough that buyers start to come in? So what happened on this particular example? So we gapped below the 21-day, which is pretty common. We gapped below the 50-day as well. So for me, like if I did, I don't own Apple directly, probably through ETFs. I'm sure I have exposure to Apple. Would I sell it on the initial gap? Like maybe I would take, I would reduce part of the position. Is probably how I would think of it. All right, let me take a little bit off, and then see what happens next. What's happened afterwards? Like, did we go below any key support levels? Like, not really. I mean, the main support on Apple's like down here at the June low. The 200-day moving average was kind of down in this sort of 270, 280 range as well. So like that for me is like a big cluster of support, which we're still well above this. So we didn't gap so below those. We kind of gapped to a level above those. But look what happened after the gap, right? That gap day was here. Number one, we closed in the upper half of the day, which told you even after that gap down the next morning, we closed above the open. So at least there's some buying coming in. That day's low, the day after earnings, we haven't even touched that level yet, which is right around 300. In the last week, actually, we've gone down to retest that point, and we bounced higher on Thursday and Friday. So I would say on the tactical time frame, on the short term, it sure looks like we're finding some footing here. And the market's kind of resetting and saying stock's worth around $300, $305 a share. So at this point, would I be like lightening up more? Like I probably wouldn't, because it's holding support. If we break support, we go below 300 next week, yeah, I'd probably lighten up a little bit more, because that would tell me we're now undercutting that gap day. If we break back above the 50-day and start pushing above this August swing high, would I maybe add back to the position? I probably would. So I think of it in a couple different stages in a gap like this. And hopefully that discussion through the chart of Apple and some of the specific implications just give you a sense of how you could use some of the tools and concepts we talk about to make sense of that kind of move. All right, final question for today's episode, then we'll call it a week. What do you mean SanDisk and Western Digital are no longer in an accumulation phase? I probably did say something like that. These names seem like the long-term trend is still quite strong. And you had a much larger, I won't say diatribe, it was a thoughtful and respectful question. But it was kind of like, hey, Keller, what do you mean they're no longer going up? I think the long-term trend is still good. It's a great question. So let's look at SanDisk. Because that's one that certainly had some movement here recently. Right. So yeah. So I would say things like an accumulation phase. When I say things like accumulation and distribution, when I say things like an uptrend or a downtrend, when I say things like a primary uptrend or primary downtrend, a lot of these are kind of generalizations about the trend and what's happening there, right? So when I'll tell you, when I look at the, last year and a half of the chart of SanDisk, for me, it's a very, sort of thoughtful visual representation or analysis of when are we clearly going sideways, like we were in July and August of last year? When are we in a clear accumulation phase, like we were during this period? And for me, what makes it a sideways trend? Well, the highs and the lows are pretty stable and the moving averages are all flat. What makes it an accumulation phase? Well, the price is above the moving averages. The moving averages are all going up. We're not getting below the 50-day. What makes it a distribution phase, which is probably why I said that was what was going on this chart, because we're breaking below the 50-day and the moving averages are kind of sloping downwards. Now, all of those things that I just said, though, are with the short-term moving averages, right? With the 21-day and the 50-day moving average. That long-term trend, I think to your point, I think both parts of your question can be right. I think, SanDisk and Western Digital, could no longer be in an accumulation phase because we're seeing distribution. We're seeing selling pressure. We're seeing a corrective move. Can you have a distribution phase on the daily chart, but still be in a great uptrend on the weekly chart? I think you can. And so I would say this is another one where maybe the multiple time frame, and SanDisk is probably not a great example because it hasn't been, public for that long, this listing that we're looking at. But I think the idea holds up, right? The fact that we're still above an ascending 200-day moving average, I think a lot of technology kind of looks like that. And the fact that the 200-day is still sloping up and we're still above it tells you that like the long-term kind of secular trend is still fine. So I would probably say like on the weekly chart, we're still in an accumulation phase. The distribution phase, because I'm usually looking like a month or two out, this looks like we're in a downtrend, right? The fact that we're breaking the 50-day for me means no longer like a strong accumulation phase. That's just the way that I use those adjectives. You may describe them a little bit differently, and that's okay, right? I mean, I think what's important is that the language we use and the charts that we use are attuned to and optimized for the questions you are trying to answer as an investor and the questions I'm trying to answer as an investor. So those phrases that I probably use to describe SanDisk, I think that's a fair way of describing this as a distribution phase within a longer uptrend. And I would argue if we can complete this move above the 50-day, which we almost did today, but didn't quite finish off, are we back in a new accumulation phase? I would argue probably we are. And that's one of the ways that I often use this particular pattern, which I call the moving average limbo, where we're between the 50-day and the 200-day. So the long-term trend is still good, but we've weakened enough that we're in some sort of corrective move, often sets us up for a really good move back into an uptrend phase. That's how I would describe the chart. That's how I would use the indicators to sort of back up those adjectives that I threw around so liberally earlier this week. Folks, that'll do it. Those were some awesome questions. I hope that my sort of discussion inspired by those questions made you think a little bit and gave you some ideas. Hopefully just gave you some tips and tricks about how to use the technical analysis toolkit. Thank you so much for watching the live show today. Those of you that are doing so, thanks so much for watching them later on our YouTube channel if you're doing that. As a reminder, no live shows for the next 2 weeks. We're going to be on the road, as I mentioned, taking my family to Iceland, which has always been on our list. If any of you have been to Iceland and have any like tips or tricks or things that were awesome or things that you would never do again, drop a comment on my YouTube channel. I would love to know. We've done some talking. We've got the Lonely Planet guide. We've got a friend of a friend who actually lives in Reykjavik that we're going to see after we land. So we're hoping that gives us some ideas, but always opens to some new ones. Our next live show will be on Monday, August 31st. So with that, I will say have a joyful weekend. We will still have content on our YouTube channel, so keep tuned, but have an awesome weekend. And remember, it's always a good time to own good charts. Take care, folks.